everybody, welcome to our weekly Wednesday webcast. Today I want to talk about how to build a billion-dollar cap table. So I want to cover 3 key points today. Number 1, our valuation. Number 2, our terms. And number 3, duration. So valuation, hopefully, is this your valuation of your company going higher and higher. Terms, hopefully they are founder-friendly terms in your term sheet. And number 3, duration is how long it will take you typically to exit your company. So let's go ahead and dive right in. So number 1 is our valuation. So when you value a company, there's both art and science. So art is definitely how you do your capital raise. So hopefully, if you're raising money from investors, you are building out an investor contact list, you are getting to know those investors before you need them, and you're setting up your roadshow in a way that everybody's on board at the same time. So everyone gets the first email at the same time. Hopefully the phone meetings happen at the same time, the in-person face-to-face meetings happen at the same time, and of course the term sheets happen at the same time. So that is the art of getting your valuation higher and higher. So what you really want to have is a bidding war. You want to have lots of interested parties at the table. You want to have multiple offers. You want to be able to say, hey, love your terms, but this other term sheet looks a little bit better, so let's negotiate. That's how you get your valuation higher. That's the art piece of valuing your company. Now, the science piece of valuing your company is a little bit more complicated. So there's 3 methodologies we typically use in valuing a company. The first one is DCF, discounted cash flow. So it's exactly what it sounds like. You would actually take your financial forecast, your pro forma, you would take your net income, and from the net income, you would remove any non-cash items. So depreciation, amortization, you want to get to what's called free cash flow. That's just pure cash. From that cash number, you want to go ahead and take a discount rate to it. So what you would do is you would take the risk-free rate, the treasury bond rate, you'd add on a risk premium to for the fact that it's actually equity and not a bond, and then you would build in other things. And so you would get to this discount rate. Let's just call it 10% for simplicity. You would take your 10%, and then you would take your 5 years worth of free cash flow, and you would discount every year of free cash flow until you got to a number you'd consider terminal value, and that would give you your DCF, your discounted cash flow. Now, as I'm explaining it, you probably already know why you would not use a DCF with a startup, because a startup doesn't have net income. And in order to get to free cash flow, you have to start with net income and then add back non-cash items. So if you have a net loss, it's not going to make a lot of sense to do a DCF. So I do not suggest you do a DCF if you're valuing your company. The second methodology is public comparables. So looking in the public market, looking at companies that are very similar to yours, that are publicly traded, and getting the revenue multiple. So you want to look at the value over the revenue. That's going to give you the revenue multiple. So I just read recently a report from 451 Group. The public SaaS market is typically about 7.1%. So if you look at all SaaS companies that are publicly traded, the revenue multiple is about 7.1. They specifically said when they look at private valuations and they compare private valuations of SaaS companies to public SaaS companies, it was about 1.3 difference. That was their suggestion on how to value a private company. I actually disagree a little bit because I think that number could change. What I like to do is take 35% illiquidity discount. And what that means is that I'm taking a discount off that 7.1 times revenue because the private company, the startup, is not traded easily on E-Trade. So you want to take 35% off the revenue multiple of a publicly traded company to get to a reasonable privately traded company's revenue multiple. So you could do that route, and that's perfectly fine. So again, looking at publicly traded companies in your space and then discounting them for 35%. And there's also other ways you can give a little haircut. So you can discount them because you're a younger company, you're a smaller company. There's lots of ways you can discount, but I think if you can just get to the 35%, that's pretty conservative. So of course you can discount lots of different reasons. So once you have that revenue multiple, then you can apply that to your company's revenue. So if let's just say, for example, our revenue multiple is 5x, 5 times revenue, and our revenue is 1 million. So then your valuation for your company is 5 million. So it's good to have an estimate to understand where you are. So as you're negotiating these terms, that you really understand what you're talking about. So one of the terms on the term sheet is going to be your valuation. So if you have no idea where your company should be valued, then you're kind of leaving up to what's called VC math. So an investor will say, okay, I want to own X% of this company and they want to raise this much. They're going to back into those numbers and that's how they're going to get your valuation. So that's perfectly fine. That's typically how it's done. But if you can have some numbers in your back pocket, it's going to help you a lot to understand kind of what range you're in. So if an investor gives you a valuation of 2 million, and you've done your homework and you say, based on this revenue multiple that I calculated, I should really be at 10 million. So always do your homework, always understand what is going on. And that's how you actually value a company. So there's the art, how you go out and do your capital raise, all the excitement you get around the deal, all the term sheets that you get in that are all bidding to be the first one or one of the investors in your round. And then you have the science piece of it. That's the actually calculating either the DCF, which I don't suggest you do, or the public comparables, which I think you can do. It's an okay way to do it. And the last methodology, which I prefer to do, and this is what I typically do, is related transactions, comparables. So these are privately traded companies that are similar to yours. Now, here's why I think this is the best methodology to use, because if it's a privately traded company, you don't have to worry about illiquidity. It's trading on the same market, right? It's trading between different investors who invest in private companies. Also, you're getting real data. So if you are looking at a publicly traded company, you're looking at lagging data. So they don't report every month, right? So you're looking at perhaps quarterly data or annual data. But if you are looking at a transaction that just happened last week in your industry, that is a good proxy for what your valuation should look like. So I specifically like to research privately traded companies, and that's how I like to build out valuation. So just make sure you have a general idea of what your valuation should be. So how to build a $1 billion cap table, the first piece of it is the valuation. Make sure you understand what your valuation range should be for your specific company. Now, number 2 was the terms. Now, so basically when you get a term sheet, you want to be really aware of things that are called warrants, pro rata rights. Those are 2 ways that can dilute your company. You also want to be watching for liquidation preference. Liquidity preference is typically 1x, 1 times. So if it's higher than that, you want to watch for that. You also want to look out for participating preferred versus non-participating preferred. And I go into great detail about what you need to look for, but I'll just kind of give you the high-level detail on this webcast. So you're looking for the participating preferred or non-participating preferred. You're also looking out for things called veto rights and anti-dilution. Veto rights and anti-dilution are pretty tame. They're things that are neutral. They're in there that's to protect both the investor and the company. But the things you really want to keep an eye out for are warrants, pro rata rights. You want to look at liquidation preference, make sure it's not too high. You also want to look at whether they're going to be participating or non-participating, which basically means they get to participate in the common proceeds. So number 2 was for terms, right? So T is for terms. And I always say that building a company is like just basically a math equation, right? So I would say for this example, it's V plus T plus D, duration, would be your $1 billion cap table. So that's number 2, your T. So let's just go ahead and jump right into duration. So duration is a little bit different because I can give you average numbers. So on average, I would say it takes about 7 years for a company to exit. So that's either an acquisition or an IPO. So I've also watched companies who take perhaps 12 years to exit their company. So you want to understand that. So what you can do is you can build out a cap table. I will leave a link below to the cap table video I did, like 2 or 3 years ago. And you can check out, it's a downloadable cap table, and you also have a tutorial that will walk you through how to fill it in. And of course, always ask your attorney. You're going to need information that only your attorney would have unless he or she has already given it to you. So if you fill out a cap table and you have a pro forma, your financial forecast, you can start to figure out, okay, here's how much we need to raise, so we can go ahead and put those numbers in this cap table. And now we're starting to see our scenario. We're starting to see, okay, here's how long it would take us to raise this amount. Here's how long it would take us to raise this amount. So you start to get a picture of what your whole funding landscape is going to look like. So most companies, I said, on average, is about 15% of the equity is held by the founders at exit. I've seen as low as 0%. Etsy and Zipcar had 0% at exit. I've seen as high as 75%. Atlassian and also Workday had the high 70s. So we talked about this and how to build a startup financial model, but I'll say it again. The way that you hold on to a lot of equity in your cap table is making sure that your valuation is high and that your terms are good. Another thing that we talked about was venture debt. So being able to use either a convertible note as you're just getting going. You also can use revenue-based loans or asset-based loans if you're early stage. And if you're a little bit later stage, you can use what's called venture debt. So if you have any questions about convertible notes, about revenue-based loans or asset-based loans or venture debt, leave me a comment below, or I'll just give you my email at the end. You can email me directly. There's lots of ways you can avoid diluting your company and hold on to lots of shares. You don't want to be like Etsy or Zipcar. You want to be like Atlassian and Workday. You want to hold a lot of your company. And the only way to do that is by not taking a lot of outside capital right away and keeping your valuation really high and keeping your terms really founder friendly. So just to recap, How to build a $1 billion cap table is focusing on your valuation. Make sure you understand your estimate. Number 2 were the terms, and if you want more information on the terms, you can watch the video below, Startup Law 101. And number 3 was duration. It takes about 7 years for a company to exit, so you have to understand as you build out your cap table and you build out your financial model, okay, with this company that we're building, we have to raise $500 million. So how long would it take us to get to an exit? And then you can start calculating out those numbers. And you can even project your own company that if you are starting today and you raise X amount in 6 months, and then 2 years later you raise Y amount, and then 2 years later you raise Z amount, you can plug those into a cap table and you can start to see how much money you're going to end up with. And this is really important for one main reason. Because as you're building your company, you're probably using your own money to start, so you're maybe even tapping into your 401k plan or getting a home equity loan out. You really want to be careful about how you're going to own it, how much you're going to own in the end. So you don't want to, blast through your savings, build this company for perhaps 10, even 12, 15 years, and then at the exit you own 0%. I mean, that's for me is my biggest why. Why I think entrepreneurial finance is so important and why I'm so passionate about it is because I've watched a lot of entrepreneurs over the years just pour all their life savings into their idea and then raise tons of outside capital. And then what they end up with is they end up with zero because they have no equity because they've diluted themselves out of their own shares. They burned through their savings and they just worked for 15 years and they now own nothing. So be really, really prudent when you plan to build your startup, build out a financial forecast, build out a cap table that's forecasted. You want to map those numbers together so you can see, okay, based on this financial forecast, I need to raise X amount. So I'm gonna go ahead and plug that into my cap table. And then you can start to see how you would dilute your company and how you would dilute your shares. And at the end of the day, you don't own 15%, you might own 0.005%. So just to recap, how to build a $1 billion cap table is really just a math equation, like everything in life. It's V, your valuation, it's T, your terms, and it's D, your duration. So if you can do those things right, you are gold. And of course, the underlying factor is always, always, always your customer's revenue. So if you are building lots of revenue, then you're increasing your valuation because remember it was your revenue times your revenue multiple. So that's one way you can fight against dilution is really focusing on your customer's revenue. Do you have product market fit? Are you getting revenue from your customers? Are you really taking a lot of the advice I gave in the last how to go from 0 to $1 billion webcast and using those practices and learning how a company like Slack was able to go from a 0 to $1 billion valuation within about a year. So you really want to focus on the people who've come before you because they've already done it. So learn from those who've come before you. Make sure you're focused on revenue, product market fit, talking to your customer, because when you talk to your customer, that's the quickest way to find out whether you have product market fit or not. So hopefully you're enjoying this journey of building a company and hopefully you're setting yourself up for success by putting these things into place right now so you have a whole process and you understand how you're diluting your company and how you're not diluting your company, because I can't think of a better motivator for increasing my customer revenue than by looking at a cap table and seeing, okay, if I don't increase customer revenue, I'm not going to have a high valuation. And if I don't have a high valuation, I'm going to dilute my company. And if I dilute my company, I'm going to spend 10 years building it and I'm going to own nothing. So I can't think of anything that would motivate me more. So thanks so much for stopping by, you guys. If you have any questions or any comments, I'll give you my email address now. It's just lili@financeforentrepreneurs.co. Email me. I answer all of my email directly within 24 hours, unless of course it's a sales pitch or something, something not related to what I'm talking about right now. So I look forward to seeing you guys back here next week. And if you have any questions or any comments, don't hesitate to email me. See you back here next week. Bye-bye.